Welcome to VeriScope News. We provide verified reporting and clear context. Our work focuses on accuracy, balance, and long-term understanding. We do not speculate. We do not sensationalize. We do not frame information to provoke emotion. Instead, we explain economic and financial developments in a calm, factual, and structured way. This report is designed to support clear understanding. It is written for steady listening. It avoids urgency. It avoids opinion. It focuses on how systems function over time. Interest rates influence nearly every part of modern economic life. They affect how households borrow. They influence how businesses invest. They shape how governments finance long-term obligations. They also affect how people save. And they influence how prices move across the economy. Over the past several years, interest rates increased rapidly across many major economies. These increases were implemented in response to elevated inflation. As inflation began to slow, many observers expected interest rate cuts to follow quickly. That expectation has not yet been met. Instead, rates have remained higher for longer than many anticipated. This report explains why. It also explains why interest rate decisions are approached cautiously, and why timing is treated as a long-term consideration rather than a short-term adjustment. Interest rates are set by central banks. These institutions are responsible for maintaining price stability. They are also tasked with supporting sustainable economic conditions. When inflation rises too quickly, central banks typically raise interest rates. Higher rates increase borrowing costs. Over time, this reduces spending and slows demand. In recent years, interest rates were raised at one of the fastest paces seen in decades. Those increases remain in place today. In most regions, rates have stabilized rather than declined. Reductions have not yet begun. Central banks are choosing to wait. They're monitoring how earlier rate increases continue to affect economic behavior. This includes household spending. It includes business investment. It includes labor market conditions, and it includes financial stability more broadly. These decisions apply across the economy. Mortgage rates remain elevated. Business loans remain more expensive. Auto financing costs remain higher. Credit card interest rates have increased. Government borrowing costs have also risen. Each of these areas responds at a different pace. Some effects appear quickly. Others take many months. Some impacts unfold over several years. This is why interest rate policy is often described as operating with delays. To understand why rate cuts are taking longer, historical context matters. Interest rates typically move in cycles. Periods of low rates are often followed by periods of tightening. Once inflation accelerates, policy responses tend to remain in place longer than many expect. This is because inflation does not decline evenly. Price pressures can slow in one area while remaining persistent in another. Economic behavior also adjusts gradually. Households change spending patterns over time. Businesses adjust hiring and investment plans slowly. Labor markets often respond with delay. In past cycles, central banks have typically waited for sustained evidence before lowering rates. They look for inflation that is not only declining but remaining stable. They assess whether price pressures are broad-based or narrow. They evaluate whether wage growth aligns with productivity. They consider whether demand is cooling without destabilizing employment. In many economies today, inflation has declined from its peak. However, it remains above long-term targets. At the same time, employment conditions have remained relatively strong. Wage growth has continued in several sectors. This combination has reduced the urgency for immediate rate cuts. Higher interest rates affect households in multiple ways. Mortgage payments remain elevated for new borrowers. Refinancing opportunities are limited. Auto loans carry higher interest charges. Personal credit is more expensive. These costs influence monthly budgets. Spending decisions often become more deliberate. Large purchases may be postponed. Discretionary spending may be reduced. At the same time, savings accounts may offer higher interest returns. Some households earn more from interest income. Others face higher debt servicing costs. The experience varies. It depends on income. It depends on debt levels. It depends on financial stability. Businesses face similar dynamics. Financing expansion becomes more expensive. Some investment projects are delayed. Others are reevaluated. Hiring plans may become more cautious. Operating costs are reviewed more closely. Despite this, many businesses continue operating steadily. Strong consumer demand in some sectors has supported revenues. Wage growth has helped sustain spending. However, higher borrowing costs gradually reduce demand. This slower adjustment is part of how monetary policy works. Governments are also affected by higher interest rates. Debt servicing costs increase. This influences budget planning. Long-term borrowing becomes more expensive. Fiscal policy interacts with monetary policy. These relationships evolve over time. They do not resolve quickly. They adjust gradually. Because of these layered effects, central banks focus on stability. They monitor inflation trends closely. They track employment data. They analyze wage growth. They observe consumer spending. They assess financial market conditions. Sudden policy shifts can introduce new risks. Gradual adjustment allows policymakers to evaluate outcomes. Some indicators may improve slowly. Others may remain stable. Not all data moves in the same direction at the same time. This complexity is why timing matters. For viewers, interest rate decisions shape everyday financial conditions. They influence borrowing costs. They affect savings returns. They impact housing affordability. They influence pricing across goods and services. Understanding the pace of change helps frame expectations. Rather than focusing on exact timing, many observers focus on trends. They look for consistency. They look for balance. Interest rate decisions reflect long-term economic management. They are not designed for rapid shifts. You have been listening to VeriScope News. Our purpose is clarity without distortion. We focus on verified information. We provide calm explanation. As economic conditions evolve, we remain committed to measured analysis and clear context. Thank you.